$4,000. That's what comes off the top of a $20,000 withdrawal from a 401k. If you have the plan, send the money to you instead of moving it directly. 20%. Withheld automatically, before a dollar of it ever reaches your account. Most people get some of that back. Some get all of it back, but not until they file, which can be more than a year later. And a few of them never see it again at all, because of a deadline nobody mentioned. And nobody at the plan is going to call and explain that to you. The paperwork just does it, quietly, in the background. Here's why this catches people who are not careless at all. For 30 or 40 years, somebody else handled your taxes. Every payday, your employer worked out what you owed, took it off the top, sent it in, and you never thought about it once. The system was invisible because it was somebody else's job. The day you stop working, that system stops with you. Your employer stops calculating. Nobody replaces them. And nobody sends the replacement instructions. That's the whole problem. It isn't that retirees are careless with money. Most of the people this happens to have been careful their entire lives. It's that a machine that ran silently for 40 years switched off, and the handover never happened. There are 8 things the IRS expects you to do the moment you stop working. 8 things that decide what you keep, what you owe, and what eventually reaches the people you love. Not one of them arrives in a letter. One thing before we start. I'm not your advisor, and I don't know your bracket, your state, or your situation. What follows is how the rules work, not what you should do. Check anything that applies to you with someone licensed or with the agency directly. Every form number I mention is public and free to look up. Let's start with the simplest one, and it's the one almost everybody skips. Number 1. Decide who is withholding your taxes now, because right now the answer might be nobody. Picture a man named David. David is 63. He retired in March. He has a pension, a 401k he's starting to draw on, and Social Security starting later this year. 3 sources of income, and here's what David assumes: that each one is handling the tax the way his employer did. 2 of them aren't, unless he tells them to. Your Social Security benefits can be taxable, depending on your total income, but nothing is withheld from them automatically. Not a cent. If you want tax taken out of your Social Security, you have to ask for it on a form called W-4V, voluntary. That V is doing a lot of work in that name. Pensions and annuity payments have their own form, W-4P. One-off withdrawals from an IRA or a plan use W-4R. And here's the part that surprises people. On many IRA distributions, the default isn't 0, and it isn't your old rate. It's a flat percentage the custodian applies unless you file the form and choose something else. So David has 3 income streams and 3 separate withholding decisions, and he made none of them. He's not evading anything. He simply doesn't know the machine turned off. Here's the part almost nobody says out loud. Getting this wrong is expensive in both directions. Withhold too little and you get a bill next spring, plus possibly a penalty for underpaying during the year. We'll get to that one. Withhold too much and you've handed the government an interest-free loan of your own money for up to 16 months. At exactly the stage of life when cash flow matters most. The action is small. Ask each payer, in plain words, what they are currently withholding. Then decide, deliberately, what you want each one to withhold. 3 forms: W-4V for Social Security, W-4P for the pension, W-4R for plan withdrawals. Free, public, and about 15 minutes each. And that leads directly into the one that costs the most. Number 2, understand what happens when money leaves an employer plan. This is the $4,000 from the start of the video, so let's take it apart. When you move money out of a 401k or a similar employer plan, there are two ways to do it, and they look almost identical on the request form. In one, the plan sends the money directly to the receiving account, a trustee-to-trustee transfer. In the other, the plan sends the money to you, and you move it yourself. If the money is paid to you, and it's an eligible rollover distribution, the plan is required to withhold 20% for federal tax. Not allowed to, required. It isn't a penalty, and it isn't a punishment. It's the rule. Read that again. 20%, gone, on a transaction most people think of as simply moving their own money. Now here's where it turns from annoying into genuinely costly. To keep the whole thing treated as a rollover, you generally have 60 days to get the money into the new account. 60. And you have to deposit the full original amount, including the 20% you never received, which means finding that portion from somewhere else in the meantime. If you deposit only what actually landed in your bank account, the withheld portion is treated as a distribution, which can mean income tax on it, and, if you're under the relevant age, potentially an early withdrawal penalty on top. And this is the part that breaks people's brains. David does the exact same financial action twice, moving his own retirement money from one account to another. And the outcome depends entirely on which box got ticked on a form he skimmed. The action here is one sentence long, and it's the most valuable sentence in this video. When you move retirement money, ask for a direct transfer, institution to institution. Say the words. I want this sent directly to the receiving custodian, not to me. Then confirm, in writing, that no distribution is being made to you personally. Nobody will offer you that sentence. The forms are neutral. The default is not always the one that protects you. Number 3, and this one catches more people than it should. Your Social Security does not start on its own. Let me say it again, because it's the single most common wrong assumption in this whole subject. It is claimed, not paid. There is no birthday letter. There is no automatic deposit that appears because you reached a certain age. If you never file the application, the money never comes. And the timing of when you file is not a small decision. Claim earlier, and the monthly amount is permanently reduced. Wait longer, and it permanently increases. Those adjustments follow you for the rest of your life, and for a surviving spouse, sometimes beyond it. Picture a woman named Ruth. Ruth is 66. She's been waiting, deliberately, because she read that waiting increases the benefit. And that part is right. What she doesn't realize is that the increase stops at a certain point. And past that point, every month she waits is simply a month she didn't get paid. She isn't being patient anymore. She's leaving money on the table and calling it discipline. The reverse mistake is just as common. Someone claims the first month they're eligible without checking what it does to a spouse's survivor benefit later. Here's a counterintuitive twist almost nobody talks about. There's also a narrow window after you claim in which the decision can be reconsidered. It's limited, it has conditions, and it generally involves paying back what you've received. It exists, it's real, and almost nobody knows about it while it's still open. After that window, the decision is permanent. The action: open an account on the Social Security Administration's own website and look at your actual statement, your earnings record, and your estimated benefit at different ages. Not an estimate from a calculator on someone's blog. Yours. And check your earnings record while you're there. If a year of your work history is missing or wrong, that quietly lowers the benefit for life, and the time to catch it is now. Number 4. And before I explain it, the most expensive item on this list is still coming, and it's the one where the damage lands 2 full years after the decision. Hold that. Number 4 is the one that produces the surprise bill. The tax system doesn't just want the right amount by April. It generally wants it spread through the year, roughly as the income arrives. When you were working, that happened automatically. Every paycheck, a piece went in. Now, if your withholding is thin, remember item 1, where David withheld almost nothing, you can end up owing not just the tax, but an additional charge for not having paid it along the way. It's called an underpayment penalty, and it can apply even to someone who pays their full balance on time in April. This is the part that feels most unfair, and it's worth understanding rather than resenting. Nothing was hidden. The rule has always applied. It just never touched you. Because your employer was quietly satisfying it on your behalf every 2 weeks for decades. There are 2 ways to handle it. Withhold enough at the source, which loops straight back to those 3 forms in item 1, or make quarterly estimated payments using Form 1040-EES. And there are safe harbor provisions built into the rules, thresholds based on what you paid the previous year, that can protect you from the penalty even if this year's income is unpredictable. The specifics depend on your numbers, which is exactly the kind of thing to hand to a professional rather than guess at. But the existence of that protection is the thing worth knowing, because most people find out about it the year after they needed it. Number 5, and this one has a clock on it. Around your 65th birthday, there's an enrollment window for Medicare. It's 7 months long. The 3 months before the month you turn 65, that month itself, and the 3 months after. Miss it without a valid exception, and 2 things happen. You may have to wait for a later enrollment period to sign up at all. And for some parts of Medicare, a late enrollment penalty gets added to your premium. Not once. Added to what you pay, ongoing, potentially for as long as you have the coverage. Here's the part nobody puts in a video. The rules around this get genuinely complicated if you're still working at 65 and covered by an employer plan, or covered through a spouse's plan, or you have retiree coverage, or a health savings account you're still contributing to. Some of those situations let you delay without penalty. Some of them don't. Some of them look like they do and don't. Picture a man named Frank. Frank is 65 and still working, with good coverage through his employer. Frank does the sensible-looking thing and delays, because why pay for 2? Whether Frank is fine or Frank has just started a penalty clock depends on details of his employer's plan that he has never had a reason to ask about. The action. Don't reason your way to an answer here. 3 or 4 months before your 65th birthday, contact Medicare directly and describe your exact coverage situation out loud. This is a phone call, and it's the highest value phone call on this list, because a penalty on a monthly premium compounds across every remaining year of your life. Number 6. This is the one I told you was coming, and it's the one that lands 2 years late. Your Medicare premiums aren't based only on what Medicare costs. Above certain income levels, an additional amount gets added. It's known as IRMA, the Income-Related Monthly Adjustment Amount. And here's the mechanism that catches people. And it's genuinely strange the first time you hear it. The income they look at is from your tax return 2 years earlier. Sit with that. A decision you make this year. A large Roth conversion, selling a property, taking one big withdrawal to redo a kitchen, cashing out an investment, can raise your monthly health care premium 2 years from now, at a point where the connection between cause and effect has completely faded from memory. So Frank does a big conversion at 65 because someone told him conversions are smart. And they can be. But at 67 a letter arrives, his premium is higher, and there's nothing in that letter that says, "This is because of what you did 2 years ago." Now here's the part that actually helps. If your income has genuinely dropped since that return, And for a new retiree, it almost always has, because that return is from when you were still working. There is a process to tell them. There's a form for reporting a life-changing event, retirement being one of them, and it can get the adjustment reduced or removed. Most people never file it. They see the higher premium, assume it's simply what Medicare costs, and pay it for years. The action: if your income dropped because you stopped working, look up the Social Security form for reporting a life-changing event and ask about it explicitly. And going forward, before any large one-off financial move, ask one question: what does this do to my income in the year they'll be looking at? Number 7. And this one isn't about your money. It's about who gets it. Your retirement accounts and your life insurance don't pass through your will. They pass by beneficiary designation, the form you filled in when you opened the account. And when those two documents disagree, the form usually wins. Read that again because it undoes a lot of careful planning. You can have a will drafted by a good attorney, updated last year, saying exactly what you want, and a 401k form from 1994 that names somebody you haven't spoken to in 20 years. The 401k doesn't check the will. This is how retirement accounts end up going to an ex-spouse. Not through malice and not through a legal loophole. Through a form nobody thought to revisit after a divorce, a remarriage, a death, or a job change that moved the account somewhere new. And there's a second layer: contingent beneficiaries. If your primary beneficiary dies before you and there's no contingent named, the account can fall back to the plan's default rules, which may be nothing like what you'd have chosen. The action is genuinely the cheapest thing on this list. Make a list of every account that has a beneficiary, every retirement plan from every employer you've ever had, every IRA, every life insurance policy, every annuity. Log in or call and read what it currently says, not what you remember it says. Then name a contingent on each one. This takes an afternoon, and it costs nothing. And it's the single highest consequence item here for the people who outlive you. Number 8. Put a date on the calendar you won't need for years. At a certain age, the government stops letting you leave money in a traditional retirement account indefinitely. You must begin taking required minimum distributions, RMDs. Under current rules, that age is 73, and legislation has it scheduled to rise later. Two things about this that matter now rather than then. First, the deadlines around your first RMD have their own quirks, and one of them can push 2 years' worth of distributions into a single tax year if you handle the timing a certain way. One tax year, double the income, potentially a higher bracket. And remember item 6, so potentially a Medicare adjustment 2 years after that. Second, and this is the real reason it belongs in a video about the day you stop working. The years between retiring and 73 are often the lowest income years of your adult life. Your paycheck has stopped. Your RMDs haven't started. For some people, that's a decade-long window where your taxable income is unusually low. What you do inside that window, or fail to do, shapes every tax year after it. That's not a decision for age 73. It's a decision for the year you retire, which for many people watching is right now. The action is small. Write the year you turn 73 somewhere you'll actually see it. And treat the years between now and then as a distinct planning period rather than a waiting room. So let's name the thing all 8 of these have in common, because it isn't tax law. It's what doesn't happen. Nobody writes to tell you your withholding stopped. Nobody calls to say your Social Security is sitting there unclaimed. Nobody at the plan explains that ticking the wrong box costs you 20% for 60 days. Nobody connects a letter about your Medicare premium back to a decision you made 2 years earlier. Nobody reads your beneficiary form back to you. The system runs on what you ask for, not on what you're owed. So, find out who's withholding what. Move retirement money directly, never to yourself. Claim the Social Security. Cover the tax through the year, not just in April. Make the Medicare call before 65, not after. Ask what this year's income does to a premium 2 years out. Read every beneficiary form you've ever signed. And treat the years before 73 as the planning window they are. None of that has to happen this afternoon. Pick the one most likely to apply to you and start there. Most of these are a phone call or a 15-minute form. $4,000. That's where we started. 20% off the top of a $20,000 withdrawal, taken automatically from a man who was moving his own money from one of his own accounts to another. These 8 things aren't loopholes. They aren't tricks, and they aren't clever. They're just the rules. Something else used to handle them for you, quietly, every 2 weeks, for 40 years. Now you do. Take care of yourselves, and take care of your money.